Well, RPOA, formerly Money Matters, has just concluded another excursion into the land of market timing, or trend watching, as Ken Moraif likes to call it. It's market timing, but whatever. So RPOA apparently put 100% back into equities, the stock portion of your portfolio. And now with this latest market timing attempt, to the untrained eye, if you just looked at a price return chart on Yahoo to see how you RPOA clients would have done had you stayed in the market, it might appear that you saved about 5.45% by being out of the stock market with just this latest market timing attempt. And then you subtract the 1.25% average annual management fee, that leaves you with a net gain of 4.2%, right? Well, I'm going to be the bearer of bad news, and where to begin? I read in their Form ADV disclosure that as of April 2022, which is when they had you RPOA clients who may happen to use them to manage your money in their so-called invest and protect strategy. So as of April 2022, they switched over to Pershing to be the custodian of your money. And I read that, okay, you're also going to be charged a 0.3% fee by Pershing. And by the way, RPOA keeps about half of that, did you know? But so that's going to increase your fees from 1.25% to 1.55% per year, beginning from April 2022. Again, and that's if you're having RPOA do this market timing thing for you. By the way, if you're a client who has been having RPOA do all this buying and selling for you, with whoever it is that was the custodian of your money, TD Ameritrade or whoever, my question for you is, was there a similar so-called platform fee? I'm curious. And if TD Ameritrade or whoever wasn't charging any extra fee, why didn't RPOA stay with TD Ameritrade or whoever? Was it because of this conflict of interest? The fact that they now earn another 0.14 to 0.18% of your money per year while attempting to time the market with a strategy that has failed so badly? But so after this extra fee by April 2023, we're now down to savings of 3.9%. That's after the annual management fee and this new platform fee since April 2022. But so what else? Keep in mind that with this previous market timing call, RPOA got back into the market only 26 days earlier. So they sell, they buy back in, then 26 days later, sell again. So in reality, this was all really the same market correction, the same market timing attempt just split in two. And in that prior attempt, they missed out on gains of roughly 7.47% by being out of the market. So if you treat it all as one market timing attempt, you actually missed out on about 3.57%. You lost 3.57% versus had you simply did nothing by sitting out this 24.5% drop of the S&P 500 total return index, which, by the way, is very consistent with Moraif's historical average break-even point that I've analyzed in my previous videos. I predicted this. Anyway, so platform fees and treating it all as one market timing call. But it doesn't end there. I'm not done. We need to back up and talk about the mutual funds that RPOA had people invested in before they got out of those funds. So if you used RPOA as the custodian of your money, as opposed to you handling your own money with a self-directed account like with Charles Schwab, investing in index funds, you might have actually missed out on more than 3.57% when we consider mutual fund performance, before the market timing attempts versus low-cost index fund performance when you just buy and hold. And when we consider mutual fund expense ratio fees versus low-cost index funds. Because I discovered that the equity fund that RPOA had apparently put clients' money into, TCOEX, and I'm assuming they got into TCOEX back when they started getting back into the market in 2020 in 4 installments. Maybe they invested in something else, then switched to TCOEX. Let me know if I'm wrong. But sure enough, we have shortfalls of, on average, 4.75%. Also, if I'm not mistaken, these Yahoo Finance numbers are price return numbers, meaning they don't include dividends. If you want total return numbers, which include dividends in the charts, then you have to head on over to a site like ycharts.com, although they charge a fee, but you can do a free trial. But so VOO, at least currently, pays 1.34% more in dividend yield than this equity fund that they put clients' money into. So if I'm not mistaken, we need to factor this in too. So I'll do that. If we assume this current 1.34% dividend discrepancy number is about this, or was about the same during the time that you were invested in TCOEX, which was for about a year and 5 months from, mid to late 2020 to February 2022, then we add, it would be 1.34% multiplied times 1.416. That's 1.9% to this 4.75% figure. That takes us to a TCOEX 6.75% shortfall versus the VOO index fund. Then we add this 6.75% fund underperformance number to the 3.57% of missed gains from being out of the market that I talked about earlier. That's about a 10.22% shortfall from the point when you got back into the market back in 2020 all the way through the time you got out of the market to the point that you got back in on February 1, 2023. A 10.22% shortfall during this time period, if all my assumptions are correct. Also, I don't know if expense ratio is even calculated into these fund performance numbers. If not, that would further reduce your returns because I discovered that this fund is expensive. TCOEX has an annual expense ratio of 0.69%. Compare this with S&P 500 index funds like IVV, which is 0.03%. So if we add on the increased expense ratio, that's an extra 0.2% per year. So remember that it was a year and 5 months in the market, so we would subtract about another 0.93% from returns. Again, that's if expense ratio is not part of these fund performance numbers. So the bottom line is that it appears to me as though RPOA clients would have been much better off owning and holding a plain old S&P 500 index fund from mid-2020 there to February 1, 2023. Or if we want to go back all the way to 2007, forget about it. According to my estimates and assumptions, you're roughly about almost 53% in the hole. Or from 2009 onward, you're somewhere around 113, 114% in the hole. And this doesn't even factor in the things that you see on your screen that may apply. Anyway, now we move on to bonds. As you recall, I think I mentioned in my last video, RPOA sold off the bond portion of people's money, reportedly sold TCOBX on 2/24/2022 and sold TCOFX on 4/12/2022. Now, after their last bond market timing attempt, RPOA reportedly bought back into all bonds on or possibly before 7/6/2020. Unfortunately, I don't know what they bought. Was all this TCOFX, that fund? Because one of the bond funds, TCOBX, that they later sold hadn't even come into existence until a little more than 6 months later. So I'm confused. And this will prevent me from getting the most accurate assessment of how this market timing attempt played out. Not that it really matters in the grand scheme of things, but I'll try anyway. One way to gauge performance, of course, is to just look at BND and see how it did. Include dividends, subtract RPOA's 1.25% management fee each year, start subtracting the annual 0.3% platform fee in April 2022, and credit sideline RPOA cash with money market interest. And if you do that, you saved about 5.52% by being out of the market with just the bond portion of your money so far as of February 1, 2023. And this is ongoing, though, because they remain out of the market with the bond portion. But of course, this doesn't consider if the funds that RPOA used were more expensive, if they paid lower yields, and if they performed worse compared to BND. And this time I'm not going to confuse you with all the minutia, but with TCOBX, I'm showing a 4.15% deficit. And with TCOFX, I'm showing a net gain of about 0.2 of a percentage point. So hypothetically, if they invested half and half in each fund, which they didn't, because again, the one fund didn't even exist until 6 months later, but if that were the case, you lost 3.94%, or should I say underperformed BND, but then you gain 5.52% by being out of the market. So finally, for a net gain on the bond side of 1.58%. So there you have it. My guess is that since 2020 and as of 2/1/2023, by having RPOA attempt to time the market and pick and choose funds for you instead of just holding plain old index funds, you've saved roughly 1.58% with the bond portion of your portfolio, and you've lost roughly 10.22% with the stock portion. But there's one more thing that I still haven't talked about. Yes, taxes. Now, the bond portion of your portfolio went down since the last time they bought it, so we ignore them. There are no capital gains. But after RPOA management fees, the stock portion of your portfolio grew roughly about 25.68% since their last market timing attempt. And fortunately, these were long-term capital gains this time. But as I've said before, whatever amount you pay in taxes represents money that no longer gets to continue to go to work for you. Also, if you have beneficiaries, if they inherit your nest egg, up to a certain dollar amount, they shouldn't be paying any taxes. At least in California, something like the first $3 to $5 million is tax-free. So from their perspective, it's not just about money no longer going to work. It's all that money that you paid in taxes is money that your heirs should have inherited instead of Uncle Sam and Uncle State. Taxes matter. Is this thing on? Anyway, so it was a 24.5% drop of the S&P, and think of that. You still lost as much as 10% by trying to time the market. Imagine that. All this doom and gloom, Joe Biden's insane war on American oil driving up fuel costs. We had the war in Ukraine exacerbating the problem, interest rates spiking way up, recession talk, inverted yield curves. Jamie Dimon was saying that the Dow might go down to 23,360. It seemed like this was the easiest slam dunk of a market timing opportunity. Instead, all we got was a 24.5% drop of the S&P. And you, our POA clients, if you've been on board with Money Matters since 2007 or 2009, this has been a grand failure. I mean, at this point, if you're a fiduciary, I don't know how you defend this market timing strategy. The only argument is, well, it might start working moving forward. That and, well, I don't want you to lose sleep when the market goes down. Okay, so you're having to unretire comfortably. The stress is brought on slowly. When you miss out on gains by sitting on the sidelines, it doesn't feel as stressful as losing money when there's a stock market crash. It's the same damn thing as a stock market crash. Your account value is down here instead of up here. But you feel safe along the way. No stress. Or, of course, you sell it by cherry picking. You keep talking about 2008, the one time your strategy worked. By the way, I don't even think that market timing call is much to brag about. He got it half right because when the S&P total return index finally bottomed out, it was down 55.25% off its peak. At this point in time, at least on paper, Moraif had saved his clients a whopping 51%. When you save your clients a whopping 50%, how do you not get back into the market? Opportunity of a lifetime. Forget about your friggin' moving average metrics. We haven't reached our buy signal yet. Who cares? Instead, he inexplicably sat around and waited for the market to recoup, from the perspective of the rock bottom price of $1,095, whatever. to the eventual Money Matters buy-in price of 1,541.7, you sat around, you missed out on 40% in market gains. I'm sorry, that is pathetic. But so I wouldn't be surprised if RPOA abandons at least their methodology for determining when to get out of stocks and when to get in, just because of fiduciary duty. But keep me posted in the comments section.